burning through $440 million in exactly 45 minutes. Welcome to the most disastrous and fastest bankruptcy in Wall Street's high-frequency trading history. Back in 2012, a dormant, 8-year-old phantom code woke up and went completely rogue in under an hour. It blasted out 4 million erroneous orders across 154 stocks, racking up $66.5 billion in trades. It wiped out Knight Capital's entire $365 million cash reserve in a single breath and left them $75 million in debt. So, how did a sleepy engineer's single misclick destroy a $210 billion empire? Let's dig in. In the last week of July 2012, Wall Street in Lower Manhattan, New York was shrouded in the sweltering heat of midsummer. On the trading floor of Knight Capital's headquarters, the air conditioning was turned down to the absolute lowest. Being too comfortable makes people sleepy, so what if the traders couldn't stand the cold? The coffee in the pantry was free-flowing. As the soul of the company, CEO Thomas Joyce had just finished a fierce argument with Nasdaq executives 3 months prior. During Facebook's IPO, Nasdaq's trading system crashed, leaving billions of dollars in orders unexecuted. Joyce furiously and publicly denounced this, stating it was destroying market confidence. This tough stance made him the knight defending trading fairness in the eyes of the media. On Wall Street, a place reeking of money and filled with dirty schemes, countless hypocrites were cursing out loud while simultaneously flocking to a certain office. This place held the temptation of money and the magic of fame and fortune. At this time, Knight Capital was standing at the pinnacle of Wall Street. Founded in 1995, this market maker, relying on its first-mover advantage in high-frequency trading technology, had gradually grown into the invisible giant of Wall Street. It handled $210 billion in trading volume daily, accounting for 17% of the total volume on the NYSE and Nasdaq, meaning 1 out of every 6 trades passed through its systems. The company's proprietary SMARTS algorithmic router could split and trade orders in 0.001 seconds, 50 times faster than the blink of a human eye. The magic of high-frequency trading lies in latency arbitrage. Knight's algorithm could detect price discrepancies during information transmission within 0.002 seconds. It would execute trades before competitors' orders even reached the exchange, silently harvesting the entire market's liquidity every day. This kind of high-frequency, quantitative trading was like a weasel stealing a chicken, leaving not even a feather behind. During the 2008 financial crisis, when the bankruptcy of Lehman Brothers triggered severe market panic, Knight Capital still managed to profit against the trend using the flexibility of HFT. In the eyes of traders, this system was a tireless money-making machine. In 2011, Knight Capital's net profit reached $196 million. Its stock price stabilized above $10, and it had cash reserves of $365 million, enough to weather any conventional market volatility. However, a phantom code that everyone had forgotten for 8 years was curled up deep within the system. On the afternoon of July the 31st, 2012, engineers in the technical department were busy conducting final tests for a major system upgrade. They needed to install a new module in the SMARTS system to connect with the retail liquidity program recently launched by the NYSE. This program allowed retail orders to get better pricing, and Knight Capital hoped to use this opportunity to seize more market share. Technical Director Steve pounded on the table in the conference room, demanding that the deployment of all 8 servers must be completed before the market opened the next day. Little did he know that this very pressured command would lead to one of the most disastrous technological catastrophes in financial history. Jesse, the youngest engineer on the team, was responsible for the actual operation. The young man, fresh out of Carnegie Mellon University, had stayed up for 2 consecutive nights testing the new code, and his eyelids were fighting to stay open. He opened the deployment checklist and ticked off the server numbers one by one. Number 1, number 2, up to number 7. When he reached the 8th server, a system update prompt suddenly popped up on the screen. He hastily clicked to close it, and when he looked back, he mistakenly marked the 8th server as completed. At 6 a.m. on August the 1st, Jesse suddenly jolted awake from his sleep. He felt like he had missed a server. He rushed to the company immediately, wanting to double-check, but was stopped by Mark. With only an hour left until the opening bell, clients were waiting for the new program to go live. There was no time to retest. They had to proceed as planned. At 9:30 a.m., the NYARK's East opening bell rang right on time. Knight Capital system began processing the first batch of orders, which included a buy order for 100,000 shares of China Cord Blood Corporation, CCBC, from Scottrade. 7 servers operated normally, and the new module split the 100,000 shares into 100 smaller orders to be executed at the best prices across different exchanges. But the disaster on the 8th server began. The instructions from the new module triggered a system vulnerability. It could only split the orders but could not receive the stop command. At 9:31:07, CCBC's stock price started to fluctuate abnormally. Knight's system bought shares at $10 each and immediately sold them at $9. The system mindlessly kept buying and selling, taking a massive $1 loss on every single share. What was even more terrifying was that the system had already completed its task of trading 100,000 shares, yet it failed to trigger the stop command. It continued to split orders and trade, essentially giving free money to the market. At 9:35, Trader Cohen noticed the anomaly. On his screen, CCBC's trading volume had suddenly spiked to 5 times its daily average, and Knight's position loss had already reached $2 million. He immediately called the technical department, saying the system seemed to be placing orders randomly. The tech team initially thought it was data lag, until 9:40 when another stock, eHouse China, plummeted by 50%, and Knight's sell orders were still flooding the market endlessly. The horror of this disaster lay in its nature of automated slaughter. Human reaction speed completely failed to keep up with the system's speed of destruction. At 9:41, the NYSE's monitoring system sounded the alarm. 154 stocks were experiencing abnormal volatility, with 80 being aggressively bought and 74 maliciously shorted. John, the vice president of the exchange, urgently called Knight Capital. "What on earth are you guys doing? Our circuit breakers are about to give out." The most dramatic case was the stock BNF. Knight's system bought it at $35 per share and immediately sold it at $33. However, due to the surging buying pressure, the stock price was pushed all the way up to $40. The system seemingly refused to accept this. It wanted to lose money but wasn't allowed to. The system automatically bought again at $40 and then sold at $38. I'm determined to lose these $2 today, and even Jesus can't stop me. I said what I said. By this time, Knight's trading room had completely descended into chaos. In just half an hour, the loss figures on the screens were jumping at a rate of $160,000 per second. At 9:32, the loss was $5 million. At 9:35, it broke $20 million. At 9:40, it exceeded $100 million. And by exactly 10 o'clock, the loss had reached $320 million. The traders frantically clicked the close position buttons, but human speed in closing positions was nowhere near the quantitative system's speed in generating erroneous orders. At 10:05, U.S. regulators urgently intervened. Chairwoman Shapiro furiously yelled at Joyce over the phone, "Halt trading immediately. Otherwise, we will forcibly freeze your accounts. Joyce was in a meeting with the tech team at the time. He slammed the phone down and roared at Steve, "I don't care what method you use, shut it down." Steve rushed into the server room shouting, "Shut down all servers immediately." But it was too late. The 8th server was like a financial suicide bomber, relentlessly pumping out 4 million erroneous orders in 45 minutes. Even after cutting off the server network, it had already sent out a massive number of pending order instructions to the exchange. Even disconnected, these dispatched orders were still executing. It wasn't until 10:15 that Knight Capital and the exchange finally reached an agreement to temporarily freeze Knight's trading accounts, which finally stopped the bleeding. By then, the system had automatically completed $6.5 billion in trading volume, and Knight's final net loss was locked at $440 million. In other words, this systemic rebellion not only wiped out the company's $365 million in cash reserves, but also left them $75 million in debt. As the news broke, Wall Street was in an uproar. Bloomberg's front-page headline read, "Knight Capital loses $440 million in 45 minutes, sets Wall Street's fastest bankruptcy record." Losing $160,000 per second was equivalent to burning a Lamborghini every minute, burning 45 of them in 45 minutes. At 2 p.m. on August the 1st, Knight Capital held the gloomiest emergency board meeting in Wall Street history. Joyce looked at the executives in the conference room, his face pale enough to match a ghost. "As a publicly traded company, we must confess the losses. Otherwise, we will be charged with securities fraud or even insider trading," he stated. Realizing honesty wasn't the best policy, it was just the only legal one left. At 4 p.m., the company issued an announcement, framing an apocalyptic $440 million meltdown as a mere technical glitch. The market wasn't fooled. Knight's stock price instantly plummeted by 33% in after-hours trading. What was even more fatal was the immediate exodus of clients. Scottrade's CEO bluntly refused to entrust funds to a system that could explode at any moment. And by nightfall, Knight had lost 70% of its order sources. Early the next morning, their bank delivered the final blow, freezing a $200 million line of credit because cash reserves had vanished. Now swimming in $75 million of debt, they couldn't even afford payroll. Joyce gave his CFO an ultimatum: "We have 48 hours. Either we find a $400 million capital injection, or we file for bankruptcy." A fundraising campaign destined to be a desperate fire sale began. Joyce personally led a team to visit 12 institutions. All felt the risk was too high and directly rejected the investment. The two willing to invest were more ruthless than the other. Blackstone demanded 70% equity for $400 million. Goldman Sachs demanded 100% control and required the entire tech team to leave. Ultimately, General Atlantic, allied with Blackstone, DD Ameritrade, and 3 other institutions, agreed to inject $400 million. The condition was that the new investors would jointly hold 70% of the shares, diluting the original equity to 30%. This meant the wealth of the original shareholders shrank by 70%. The agreement merely preserved the shell of the company, but completely buried Knight Capital's independence. But Joyce had no choice. After the disaster, U.S. regulators launched a 2-month investigation. A 45-page report uncovered a crueler truth. This catastrophe was not an accident, but an inevitability. In the end, Knight Capital was fined $12 million, setting the record for the highest fine in the high-frequency trading sector. In October 2012, although the newly injected Knight Capital temporarily stopped the bleeding, it had completely lost its core competitiveness. Clients did not trust its system, and employee morale was shattered. At this point, a predatory rival appeared. Getco was a rising star in the high-frequency trading arena, known for its aggressive style. Following the disaster, Getco took the opportunity to poach 20% of Knight Capital's core engineers and snatched away Vanguard's orders. In November, Getco proposed an acquisition, buying Knight Capital at $3.75 per share to merge and form KCG Holdings. This price was 150% higher than the $1.50 per share when General Atlantic and the other 6 institutions injected capital, but it also meant that the name Knight Capital would completely disappear from Wall Street. In July 2013, KCG Holdings officially launched, and they slapped Getco's logo right over the headquarters. Old signboard, although Getco appointed Joyce as executive chairman, they stripped away his actual power, forcing him to quietly resign. 6 months later, the 2 buyouts of Knight Capital were dubbed a feast for vultures by the New York Times. Getco swallowed the former industry leader for only $1.8 billion, leaping to become the largest market maker on the NYSE. Meanwhile, the retail investors who got crushed by Knight's collapse received absolutely nothing. Regulators conveniently ruled that system errors didn't qualify as voidable trades. Wall Street simply swept the ashes under the rug, plugged in a faster server, and went right back to breaking speed records after all. What's a few blown-up retail portfolios when you've got milliseconds to shave off? So while the neon lights of Wall Street keep flickering, don't hold your breath waiting for lessons to be learned. The machines are still faster. The code is still evolving, and you're still just the collateral damage in a race you didn't even know you were running.